In early 2026, a conflict in the Middle East sent oil prices surging. Yet 3 months later, the stock market indices have remained virtually flat. Most people see this stability and assume the immediate shock has passed. The consensus in the media is that the economy has absorbed the blow and avoided a crash. But the 1973 oil crisis followed this exact trajectory. When war broke out and oil prices spiked by 300%, the market didn't panic. It stayed strong for the first 3 months. That strength lasted for half a year. Investors felt a powerful sense of security, believing the economy was resilient enough to handle the sudden rise in energy costs. The historical data shows a recurring gap. In 1974, the stock market plummeted 45%, but that crash didn't happen during the embargo. It hit exactly 6 months after the crisis was declared over. The 1973 crisis was preceded by a massive structural shift. In 1971, the United States removed the dollar from the gold standard. Decoupling the dollar from gold removed the physical constraints on the currency. This allowed the government to expand the money supply at will, creating a high inflation environment before the first barrel of oil even spiked. The setup for 2026 is nearly identical. Our current crisis was preceded by the trillions of dollars printed during the 2020 pandemic lockdowns, when businesses were closed and stimulus flooded the economy. This existing inflationary environment acts like economic dry rot. The system looks sturdy on the outside, but is highly vulnerable to sudden external pressure. Geopolitical conflicts rarely create the underlying economic decay. Instead, they act as the match that ignites the pre-existing fuel. Economists refer to this process as inflation lag. When an oil shock hits, it takes anywhere from 6 to 18 months for the real economy to fully absorb the pain. Oil acts as a price floor for the entire global supply chain. It dictates the cost of the diesel fueling the ships and trucks that move every physical product we consume. As transport costs rise, they bleed into agriculture by making fertilizer more expensive to produce. Months later, that extra cost shows up in the price of the groceries you buy off the shelf. You can see the delayed reality of this in the 1970s. Severe fuel rationing and strict limits, like this $3 cap, remained in place long after the initial geopolitical shock subsided. Because of this lag, even if a war ends and oil prices drop today, the chain reaction guarantees consumers face months of continued high prices. In year 1, stocks plummet 43%, while gold rises 68%. 10 years later, inflation hits 125%. Gold and real estate preserve wealth, but stocks struggle. By year 20, the trend reverses. The stock market explodes 328%, overtaking all others. The difference is utility. Gold is a passive vault used to protect money from devaluation. Stocks represent active companies that spend decades generating new products and compounding profit. Surviving an economic shock requires a phased approach, holding hard assets in the short term for protection, then shifting into productive assets for long-term growth. Returning to 2026, the current market stability is likely temporary. If history repeats its pattern, the real impact on asset prices and the job market will hit 6 to 12 months from now. This chart maps the reality of wages over 20 years. While the salary line rises, it is entirely overtaken by a cumulative inflation rate of 228%. Mathematically, this means the average person relying strictly on a paycheck becomes poorer. Their income rises, but the purchasing power of those dollars evaporates even faster. You cannot survive a lagging inflationary shock as a passive earner. To stay ahead of this decay, you must actively move your capital into the assets that capture that growth.